So your business is flying. Sales are climbing, you're doing great, and then you see it on the horizon, that dreaded VAT threshold. And a little thought pops into your head. Hey, what if I just split my business in two? It sounds clever, right? A simple way to keep everything under the limit. But is it actually a good idea? Or is it a trap waiting to spring? Let's get into it.
This is a massive question for so many business owners, and to get it right, we're going to walk through a fantastic analysis put together by the experts at ProTax Accountant. They see this stuff day in, day out, and they've laid out exactly what you need to know.
All right, let's start with the magic number, the one that keeps every growing business owner in the UK up at night. £90,000. For the 2025/26 tax year, this is the VAT registration threshold. The second your taxable turnover hits this number over any rolling 12-month period, you are legally required to register. No ifs, no buts. And that, of course, is where the temptation kicks in. Maybe your turnover is creeping up to 85, 88 grand, and you think, I'll just start up business B to take on the new clients. That way, both stay under 90,000. It feels like a genius move. But the crucial question is it legal? So here's our game plan for today. We're going to look at why this £90,000 problem is such a headache. Then we'll dive into HMRC's specific rules on this, the 3-link test they use to sniff this stuff out, the really high cost of getting caught, and then the good stuff, the smarter, safer ways to manage your VAT. And finally, where to get proper advice.
First things first, let's be honest about why this idea is so tempting to begin with. It really all boils down to the huge financial pressure that VAT registration puts on a small, growing business. The second you register, bam, you have to start adding 20% VAT to your prices. Just imagine you run a lovely little beauty store. That £20 perfume you're selling, it suddenly has to jump to £24. For your regular customers, that's a serious price hike. And if your clients are other small businesses that aren't VAT registered themselves, they can't claim that VAT back, so they might just go find someone cheaper. You can totally see why people want to avoid this, right?
Now, while you and I might call it splitting the business, HMRC, well, they have a much more official, and let's be honest, a much more intimidating name for it. They call it artificial separation, or disaggregation. And this isn't just some internal guideline. This is written right into UK tax law. And this is exactly where HMRC gets its power. This quote here is straight from the Value-Added Tax Act of 1994. It literally gives them the legal authority to look at your 2 businesses, or 3, or however many, and say, nope, we believe these are artificially separated, and we are now treating them as a single business for VAT. The law is crystal clear. So how on earth does HMRC decide if your 2 businesses are genuinely separate, or if it's just one business wearing a clever disguise? Well, they have a specific method they use. It's called the 3-link test, and it's all about finding significant connections. Let's break it down.
It all comes down to these 3 pillars. HMRC will put your entire operation under a microscope, looking for any substantial financial, economic, and organizational links. And here's the thing, they don't need a mountain of evidence. Often, just one strong link in each of these areas is more than enough for them to make their case.
Okay, let's start with financial links. This is often the smoking gun. Are you using the same bank account for both businesses? That is a massive red flag. Are you just shuffling money between them without any formal loan agreements? Does one business basically keep the other one afloat? Think about it. If you're a freelancer in London with a design business and a consulting business, but all the money just lands in one single bank account, as far as HMRC is concerned, that's one financial pot. Next up, economic links. This is all about what the world sees. How do your businesses look to your customers? Are they serving the same people? Do they share a website or a brand? A classic example is a little bed and breakfast that also runs a supposedly separate company to provide dinner to the very same guests. To any sane person, that's one business, one experience. That's an economic link. And finally, we've got the organizational links. This is the behind-the-scenes stuff, the nuts and bolts of how the businesses are actually run. Is it just you making all the big decisions for both? Do you have employees who work across both companies, but they only have one contract? Are both businesses running from the same office without a proper lease agreement between them? If the management, the staff, and the location are all tangled up, then that separation is just on paper. Now, stay with me because this next point might surprise you and is probably the most important thing to understand. It's a real pro tip. HMRC does not need to prove that you intended to avoid paying VAT. Your intention is completely and utterly irrelevant. All they have to show is that the effect of you splitting your businesses was that VAT wasn't paid when it should have been. Saying, oh, I didn't know, is not a defense. This slide lays it out perfectly. It's a great visual. On the left, you've got the high-risk setup, the one that screams artificial separation. Shared bank accounts, shared staff, one location, one brand. On the right, you have the low-risk, genuinely separate setup. We're talking distinct bank accounts, proper employment contracts, formal leases, independent branding. The difference is night and day.
So what happens if you take the gamble and lose? Thinking you can outsmart HMRC on this is a really, really high-stakes game. Because if they investigate and they ruled against you, the consequences are severe. And they can wipe out years of what you thought were savings in the blink of an eye.
Here's the chain reaction of what happens next. First, HMRC issues a direction to legally treat your businesses as one. Then they backdate your VAT registration to the exact day your combined turnover first crossed that threshold. That could be years ago. Which means you'll get a bill for all the VAT you should have been paying all that time, plus interest on that amount. And then, on top of all of that, they'll hit you with significant penalties. Let's put a real number on this to show you how painful it can be. Let's say your two businesses had a combined turnover of £150,000 in just 1 year. Your backdated VAT bill for that year alone would be around £25,000. Just imagine getting a letter demanding that amount of cash right now, before they've even added interest and penalties. It's an absolute cash flow nightmare. And speaking of penalties, this table shows you how HMRC's mind works. They almost never view business splitting as just a careless mistake. They usually argue it was a deliberate action. Now, if they're the ones to catch you, what they call a prompted disclosure, you're looking at penalties between 35 and 70% of the VAT you owe. And if they think you actively tried to hide the links, that penalty can jump all the way up to 100%. The financial risk is just huge. Okay, that was the scary part, but the good news is you don't have to resort to these risky tactics. There are completely legitimate HMRC-approved ways to manage your VAT obligations as your business grows.
Look, if you have a genuine commercial reason to have two separate businesses, that can work. The absolute key is to make sure they operate at arm's length. That means formal contracts, proper invoices for any shared resources, the whole shebang. But there are even smarter options. You can look into official VAT schemes. The cash accounting scheme is brilliant for cash flow. You only pay the VAT when your customers actually pay you, or the annual accounting scheme, which cuts your admin down to just one return a year. And for many businesses that sell to other businesses, voluntarily registering for VAT can actually be a great move because you get to reclaim VAT on all your costs.
So, we've covered the rules, the risks, and the right ways to approach this. It's clearly complicated, and the stakes are incredibly high. Which brings us to the single most important takeaway from all of this. Trying to navigate these waters by yourself is just not worth the risk. The solution is simple. Get professional advice before you make any big decisions about your business structure. The experts at ProTax Accountant can give you clear, straightforward guidance on VAT and help you set things up correctly and safely. You can reach them on WhatsApp or by phone at 07985689912 or just drop them an email at info@protaxaccountant.co.uk.
And of course, we have to say this, the information we've talked about today is for general guidance. Your tax situation is unique to you, so you must always consult with a qualified professional, like the team at ProTax Accountant, before making any big financial decisions. Really, it boils down to this. Is trying to avoid VAT today worth risking the entire future of the business you've worked so hard to build?